Hey, welcome back to my channel. In this video, I wanted to review two really exciting companies, AppLovin and Viant. Both of these companies are a technology play. What they do is they have an application, a platform where advertisers can use either platform to better advertise on all the different media outlets that are online today, including YouTube, Facebook, Instagram, you name it. AppLovin or Viant will help you measure the success of your advertising dollars and then be able to spend them more wisely. They've been a huge hit. AppLovin is growing tremendously, and Viant is also growing very fast. One is much larger than the other. I thought it'd be a good compare. AppLovin's become quite valuable, and Viant is a fairly valuable company as well, but really a fraction of AppLovin. What I'm going to do is I'm going to evaluate these companies and try to determine for myself as an individual investor what the value of each business is down to a stock price value, and then compare it to its current stock price to see if this is a good investment for me. The AppLovin stock as well as the Viant stock, it rose really fast. In the last 6 months, the stock really took off. But in the last month and a half or so, the stock's really gone down in price. So is it an opportunity? Will it be an opportunity? At the rate where it's falling, at some point, AppLovin and Viant might be really good investments. So I'll conclude with that at the end of this video. My process and my investing philosophy is to try to measure the intrinsic value of a company looking at their cash flows. Cash is the principal method to see how valuable a business is. So I'll go through my model and go through that process that I have and share that with you. So AppLovin, they provide products for businesses to really maximize the return on investment as they advertise online, whether they're advertising on Amazon Video, Netflix, and so forth. So the same is for Viant. Viant gives you a solution where you're able to uh, measure your success of your marketing online. Viant is far smaller, and you'll see that in the financials when we look at them, than AppLovin. They're both located in California. One is in Northern California, one is in Southern California. Both companies have recently announced their earnings. AppLovin announced them February 12th, and Viant announced them here in early March. And I'm going to go over AppLovin first, and then we'll go over Viant. So first, the revenue growth was terrific. Overall revenue growth of 43%, and that's with a number approaching $5 billion in revenue. That's very, very good growth. It's not a tiny business anymore. It's a pretty substantial business. Other things that I like are that the free cash flows expanded as expected. They have terrific free cash flows of $2.1 billion. For a young, growing business to have cash flows of that level is exceptional. That is excellent. No wonder the stock really flourished in the last 6 months. They continue to build up cash on the balance sheet. Another sign of a strong business. Pretty much no debt. That looks great. Their margins are excellent. Very high margins for AppLovin. And the earnings per share is growing very well. Overall, their statement of cash flows, I mean, it is a cash flow statement that is desired by, geez, just about any CFO at any publicly traded company. To have tremendous cash flows of this level, it's exceptional. I use the balance sheet data of cash, debt, and the free cash flows in my model. Viant also grew really, really well. They grew at 30%. They're quite a bit smaller than AppLovin. You can see that for the full year, they are a very small fraction of what AppLovin's about. AppLovin is nearing 5 billion, where Viant's only 289 million. But they grew by 30%, which looks good. As we look at this business, cash flow really expanded nicely, 37%, and they have very good cash. Not quite 2 billion like AppLovin, but $51 million of free cash flow from a small business that's growing is very, very good. Viant's balance sheet has very little debt. I think it's zero debt, a couple leases, and they have good cash balances. So Viant's looking like a really, really good business as well. AppLovin's become a $92 billion market cap company. Its revenue is nearing 5 billion. Forward P is 40. Now, this, as I showed, is a high growth business, so 40 may not be all that ridiculous. It's a buy according to analysts, and they believe it's discounted. They're basing most of that on earnings per share. When we look at their forecast for the company, we have some analysts that are really optimistic on AppLovin. They think the price target ought to be $650. And we have some analysts that are very bearish on the stock. Hey, the stock's only worth $66. So there are some people concerned with the sustainability of growth for AppLovin. The average among all the analysts that cover it, 19 analysts cover it, is that the stock is discounted 47%. So overall, analysts are really liking the business. Looks good. Now, as we look at the forecast that these analysts collectively put out there, the business is going to continue to grow. Now, they're not going to grow these really high percentages, and understood because the number keeps getting bigger, but that's still very good growth. In the low 20%, that's very, very good. And the earnings per share is going to expand at a faster rate. So I'll use that in my valuation of AppLovin. Viant's quite a bit smaller in market cap. It's 925 million, while AppLovin's way up there at $91 billion. Its revenues is good. You're paying, less than 4 times revenue for a high growth business. It's not bad. The forward PE looks pretty good at 26. Analysts also believe it's a strong buy, discounted very highly. And I think some of those fundamentals look good because the stock really shot up. It really followed AppLovin, but it's really come down. And I'll show in the graphs later that Viant probably got sold off much harsher than AppLovin. AppLovin's bigger, more recognized, understood. There's probably less risk in AppLovin because it's a known commodity. But Viant's been really sold off. Terrific balance sheet, terrific cash flows shared earlier. And we've got 8 analysts to cover this stock. One is very optimistic, believes the stock could almost double in value at $27 price target. And the worst case scenario analyst thinks the stock's worth $12. So it could come down a bit, but not too bad. Overall, 49% discount. As we look at the growth, this is a smaller business and it's not going to grow as well as AppLovin. It's going to grow at 11%, 16%, 15%. Its earnings per share will expand. It's profitable. So it's going to expand its earnings per share really nicely. So what are each of these stocks worth? Well, I'm going to answer that question in what I think they're worth to me as an investor. And I'm going to measure what they're worth based on the free cash flows I expect the business is going to produce in the future. That is the most proven way that long-term successful investors, Warren Buffett, Benjamin Graham, Charlie Munger, Bill Ackman, those very successful super investors depend on free cash flows. And I'm putting together my best forecast of those cash flows for both companies. Starting with AppLovin, their cash flows are terrific, a little over $2 billion. Now I'm going to grow those cash flows by 20% in years 1, 2, 3, and 4. That means that I expect cash flows are going to come in at these values over the next 4 years, assuming they continue to grow the way they're growing and they continue to accumulate that cash. And after year 4, it's going to keep growing at 5%, which is a very good high growth rate of free cash flow. As you get bigger, that number will fall a bit because they're just so darn big. It's hard to grow. The intrinsic value of all those free cash flows, $114 billion. They have $741 billion of cash on the balance sheet and a little bit of debt, $3.5 billion. So it reduces the overall equity value of the company down to $111 billion. The market cap of the company is $90 billion. So there is a discount of 23%. It's interesting that the AppLovin stock's really fallen recently, and it's now falling into a zone of, hey, the stock looks discounted based on its cash flows. The earnings per share give me a more fair market price, and the reason for that is their earnings per share is 6.37. I give them a P at 36. They're a good growth company, but they're going to start growing about 20%. So that's like Microsoft's growing at 20%. Some big businesses are growing at that level. And I'm going to grow them by 25% because they're expanding earnings faster than they're expanding revenue. So I get about a 6% discount if I look at earnings per share. When I combine the two, it brings that free cash flow number down a little bit because I use 1/3 of this valuation in the blend. So 17% discount on AppLovin. That's a nice discount, but it's not like a wild opportunity. Let's take a look at Viant. So Viant is quite a bit smaller. So I'm going to use a higher discount rate. I didn't cover discount rate on APPLOVIN, but I'll go for it here. So since it's smaller, obviously it has a big competitor in AppLovin that's much bigger, much more successful. There's more risk involved. So I'm going to go with a higher discount rate. And that means that I want a higher rate of return. They are producing cash flows, which is excellent. And I put a nice cash forecast there. Those cash, the free cash flow is growing by 15%, and then terminal will grow at 5%. The reason I'm using a high terminal growth value on these companies is they're in a new market. This didn't really exist 20 years ago, and it now exists, and it continues to expand. The way that advertising is being done, it's being done online. It's being done through TikTok content creators. It's very different now, and it's an expanding marketplace that both Viant and AppLovin are growing as part of. So to have a long-term growth rate of 5% is reasonable since both their market and their company is growing nicely. When I measure the value of those cash flows, I get to 1.3 billion. I add cash, they have no debt. So it gives me a nice $1.5 billion market cap value, equity value of Viant. The market cap currently is not only 922 million. So there is a bigger discount available on Viant. Interesting. On earnings per share, they're not incredibly profitable just yet. I think they'll get there. They're going to grow those. The PE is 36 on that earnings per share. I'm going to grow by 35%. So it actually shows that the price of the stock is a little bit higher than its value if you just look at earnings per share. When I combine the two, I get to a 42% discount on buying. And that's a nice discount on a small cap stock. The stock has been coming down. So two good choices here. One has a higher discount, higher risk reward situation, and that's in Viant versus AppLovin. So which one should I go for? Which one should I maybe put a buy order on? Let me think about that. The desirability of business is a really important factor in my decision to invest in a company. There's some businesses that have terrific barriers of entry. They become very dominant, almost monopoly-like. And those businesses belong in the green quadrant. They're businesses like Meta, Google Alphabet, Microsoft, Apple. They're just really, really dominant and very valuable. There's businesses in the gray that are very good businesses, but they have plenty of competition, don't have as much pricing power, and their revenue growth isn't very high. And you have businesses in the red. These are, part of industries that have just been around for a long time. A lot of competitors, very low margins, lots of, stresses on the business, like they have to hire a lot of employees, and less desirable business. So I like investing as often as I can in the green. AppLovin, I believe, has terrific advantages against its competitors. It's doing a terrific job, and its customers believe that it brings a lot of value, and that's why they've grown to almost $5 billion in market cap. Now, why aren't they completely in the green? It's because really the owners of the data are Meta, Google Alphabet, Apple. And my concern is, what if those businesses, on at some point in time, they start providing what AppLovin provides at no additional fee, just part of the relationship that they have with bigger advertisers. That might cannibalize the AppLovin business. So that's why they're not completely in the green. When we look at Viant, it's actually just touching the green, mostly in the gray, principally because their competitive advantage isn't as clear as AppLovin. AppLovin's much bigger, and these are competitors in a way. So this one is kind of a smaller company. Really, AppLovin has proven to be more successful, probably better confidence in the market, or the market's more confident in them. Businesses are probably more comfortable in doing business with AppLovin. So those competitive advantages that AppLovin has are kind of disadvantaged to Viant. I still think their business is desirable, good cash flow generation, good growth, and they can pick their spots, but they got to keep growing in order so that they can become a bigger force to reckon with AppLovin. So the story of these two stocks cannot be told without looking at their recent stock action, because this stock, AppLovin, went from $100 a share in September up to $412 a share in February. Now that's a 4 times the stock price run. Incredible and a little bit unbelievable. But since then, the market's really selling off stocks that had way too much froth. And this stock's down 47%. That's a pretty good haircut. So if you bought at any time in the last couple months, especially going back to November 8th, you're losing some money. And it may continue to fall. It looks like in the pre-market, it's falling by like 5%. The market, is at times irrational in driving up stock prices and irrational in selling off stocks. And this stock, you could see when I go to the max on Google Finance, the stock just took off a little bit parabolically, and now it's falling down, becoming a falling knife. And it's really hard to catch that falling knife without getting hurt. So this one here, I got to be careful with. Don't want to buy too early. I want to let things settle down. The stock market is not at a smooth place. It's quite noisy. For the past week, stocks, for the most part, sold off. And we had days where we had huge swings in the stock market. The stock market opened up higher, it dropped a lot, and it closed really at a big loss. And vice versa. I think on Friday, we had a market that was selling off, and then it rallied toward the end of this trading session. The volatility is extreme, and I think that AppLovin is becoming a stock that investors are staying away from until things get settled down, until risk, the VIX, if you measure that, goes down. So buying into AppLovin may be a little premature. I showed that it has an okay discount based on free cash flows and earnings per share, but it's not a high enough discount to feel like, hey, I'm going to hit a home run with AppLovin. But I could see myself buying shares today and they're worth 20% less in a month's time. So I'd like to give it some time and act slowly with AppLovin. I think the stock price looks good. It looks investable. I just don't want to invest too early with AppLovin. Vine as well had tremendous stock action. When you look at the stock over the last 6 months, the stock was trading at $10 a share and it shot up to over $25 a share. So that rise is a 250% gain in just a matter of months. But since then, the stock's really down 38%. So is this thing going to keep falling? It could. It's a small cap. It's a tiny cap. Now, along with Viant, I'm going to watch AppLovin and I'm going to watch Viant. I'm probably going to set some buy orders with a limit price at a price that I'm willing to begin to invest in both Viant and AppLovin. I'm not ready to pull the trigger on the current stock prices for two reasons. One is the market's just really all over the place, a lot of volatility, a lot of risk. And I think these two stocks could continue to sell off. So I'd hate to be buying at too high of a price. So I'm going to set some price targets on both and set them to trigger tomorrow in tomorrow's trading. I think both businesses are terrific. As mentioned, I think the AppLovin business is fantastic. They're doing a great job. And the Viant business is also fantastic, just not as big as AppLovin. It reminds me a little bit of Uber versus Lyft. AppLovin being the Uber example and Lyft being the Viant example. AppLovin just needs to keep doing what they're doing. Keep growing, keep getting bigger, keep getting more important to your customers. And Viant is in somewhat of a Lyft position. They have to grow. They have to pick the places in the market where they can dominate. They need to become a relevant factor. They don't grow, they're not going to be worth a whole lot because I would expect that AppLovin is going to take them out. So that's my video on AppLovin and Viant. Two terrific businesses. Man, the stock market with all this sell-off is creating opportunities for long-term investors. We just got to do our homework. We got to find them. We got to value these businesses, buy them at the right time, and make long-term substantial gains to grow our wealth. And that's my video on AppLovin and Viant. I hope you found it interesting. Keep in mind, I'm just an investor. I'm not recommending you buy, hold, or sell either one of these stocks. And this is not financial advice. I really appreciate you watching. Let me wish you the best of success in your investments.